Good evening, everyone. This is Al Salus with the Investream team. We're glad to have you in our September webinar. We do a monthly webinar covering different topics related to real estate, investing, and today we're going to be talking about taxes. Everybody loves paying taxes. That's what I get from all of our investors. So we wanted to address that. And we couldn't find a better person than my dear friend and CPA, Mr. Omar Kasani. He is based in Houston. I'll let him introduce himself properly. He's in different places doing different things. He's always working in different industries with different clients, and he has a very good grasp of the good, the bad, and the ugly, and what to do and what not to do. And so, Amar, we're really glad to have you today. I know you have an early flight tomorrow morning and you squeezed this in, so we really appreciate it. Go ahead and introduce yourself and we get started.
Hi everyone, good evening. My name is Omar Kisani. I am a CPA here in Houston. I've been in Houston since 2003. Before that, I was in Dallas in California where I got my MBA. I worked before with the Big Four, and then I switched to have my own practice. And then I went back to insurance industry for some insurance companies, and I have some real estate investment and partnerships here and there. So I have different view of the market, as he mentioned. Thank you for the invitation. I hope I can give a good overview of what you're looking to understand and to be able to answer some of your questions. I don't claim to know everything, but there is always a chance to check for answers and come back with the answers for everyone.
All right, thank you, Omar. Before we get started, this is a typical disclaimer. We're here for education purposes only. So if you are about to make any investment decision or take any advice from us, we encourage you to consult with your own legal and financial advisors before you do so. We'll try to make it as interactive as possible today. So Omar is going to cover a few topics and then we'll open it to questions. Feel free to submit your question in the chat, but also you can raise your hand and ask your questions. This is meant to be interactive. And we've done a similar meetup with the same topic a few months ago in Cyprus, and we had a lot of great questions. So please start, whatever is in your mind, type it in, and then at the end, we're gonna open it for Q&A. With that, we'll get started. So the first thing is, Omar, I want to ask you about. Everybody is so happy about one big beautiful bill and the tax appreciation coming back and 100% of it, and it's permanent. So tell us a little bit about what is depreciation and what does this mean to an everyday investor?
Sure. So the idea of the depreciation and the bonus depreciation and the expedite depreciation is the government is trying to encourage people to spend on big ticket items. And one way to do that, because there are many ways for the government to do that, is to allow people to deduct the money that they are spending, or most of the money that they are spending, to be deductible from the income, so they can reduce the tax liability. So, for example, if you are a 40% tax rate person and you are buying an equipment that is for $100,000, when you do that and the government allows you to depreciate the whole thing in the first year, from cash flow point of view, you are spending $100,000. You are reducing your taxes by $40,000 because the 40% tax rate is going to be applicable to the $100,000, and you will be able to feel that you spend $100,000, you're saving 40,000, so it really costs you $60,000. So from cash point of view, it will encourage a lot of people to buy equipment and material stuff that can depreciate quickly. And as you mentioned, this is one of the things that President Trump was pushing for through the One Big Beautiful Bill Act, which is more depreciation. Everyone is asking about the depreciation because it's a legal, good way to reduce your taxes.
All right, great. So here's an example. I think you want to cover that. Go ahead.
Yes, so we have many ways of having the depreciation. Let's say you are buying an equipment for $90,000, which is the one that we have. The standard way of depreciation, which is what we do in the generally accepted accounting principles, which is whenever we do the financial statement, is the last one, which is the straight line depreciation method. We say it's $90,000 equipment. We're going to use it for 5 years. The simple calculation is going to be 90,000 divided by 5 years. It's $18,000 deduction every year. That's what we do when we do the financial statements. But as we mentioned, people would be encouraged more to spend the 90,000 if they can deduct more in the first year, because I don't want to spend $90,000 and pay the taxes on that. So they come up with the double declining depreciation method and the sum of the digits depreciation method, or what we're talking about, which is 100% depreciation. As you can see, 40,000 in the first year, 24,000 second year, 14, 8, and 3,000. And then different methods, but as I mentioned, everyone is looking for the expedite depreciation in the first year.
And this, you're gonna talk about cost segregation. I was gonna say, what determines what qualifies for accelerated or normal schedule?
Uh, so usually the government would provide the taxpayer through applications with specific categories of what is a 5 years, what is a 7 years, what is a 27 and a half years, what is 39 years, and so on. And you, as a tax preparer, or us as tax preparers, or the taxpayer, is supposed to look to what qualifies to each one of the categories and categorize them there. And based on that, you will get the applicable depreciation percentage. So, for example, if you buy a computer, it's a 3 to 5 years. If you buy a building that is a commercial building, then it's a 39 years.
I
Okay?
have a question about that. Does that go to anything that you're purchasing, or is it a certain requirement to fall under this category?
You mean like in terms of cost, or in terms of what?
To have something depreciated over X amount of years?
So we have one of the depreciation methods, which called Section 179. It basically allows you to depreciate anything in the first year. So, computers, equipment, with the exception of cars. So cars, we look to see the weight of the cars, and if it's a passenger, if it's a truck, and so on. Uh, Mostly we use the double declining depreciation method for that. But most of the equipment would be depreciated the first year under the Section 179.
Yeah, I remember we used to depreciate, obviously, we depreciated all CapEx in the software development space back in the days.
Hmm.
But over time, we stopped doing it all in 1 year and started doing different methods. And one of the most famous one was 50/30/20 for software. We were doing
Yes.
it over 3 years, basically.
Yes.
Yeah.
But usually we have a change in the depreciation methods and the law every 3 4 years. So, like, in the previous years, we have the Tax Cut and Jobs Act, and then we have the Big Beautiful Bill. And most of the discussion in this act is going to talk about the depreciation. They want to encourage us to spend on big ticket items so we can keep the economy moving.
Beautiful. One of the big things that we normally do is cost segregation. So I know you had an example about that, but can you explain what that is and how does it help with real estate investment?
Sure. So, in the example that you have in the screen, there's an actual number actually for one of my clients. So they bought a property, which is an apartment complex, for $36 million. Now, if you leave the $36 million, you just depreciate the whole thing on 27 and a half years. But what we really do is we go through the cost segregation, where we have different categories for the fixed asset. So we can see in the screen the structural side of the building, the systems, the interiors, and the land improvement. Then we have windows, we have doors, we have washing machines, we have dryers, and so on. So we start segregating the 36 millions into different categories. And some of these categories would be depreciated in 5 years. Some of them will be depreciated in 15 years. Some of them will be depreciated in 27 and a half years. And this is important for the investors because someone investing $250,000, they're looking for the deduction. And this is the way to give them a big deduction. A lot of times I've seen it. Someone would get a capital contribution of 250,000 and they will get 250,000 deduction in the first year. So for them, they will reduce their taxes by the whole amount that they invested in the real estate.
Makes sense. And when you say they can deduct it, is that in the form of K1? Because many investors sometimes they don't understand how they're going to get that
Right.
back.
So like this $36 million, let's say we have 36 investors that each one put $1 million. Let's assume there is no loan or anything, which I know it's not really practical, but just for the purpose of discussion. So we have 36 members in this LLC, each one contribute $1 million. So what happens is they put $1 million, they will get a K1, which is their share of the LLC, showing a loss of the depreciation and other expenses. And let's say, just for the purpose of discussion, the K1 would be negative 500,000. So when you add that to your personal tax return, where you have W2, where you have interest, you have dividends, you have other items, or you have income from other K1s, you can use the loss from this K1 to offset your income from other sources, and that will reduce your taxes.
Very good, very good. Yeah, we kind of had a lot of success over the years, and obviously the accelerated depreciation was reducing over the past few years, and now it's permanent and it's 100% at least with this tax law until we have a new tax law.
Yeah.
And like Omar mentioned, when the actual investment is leveraged, meaning there is debt on it, then the equity is even smaller. And that's when you get into the 80 to 120% deduction out of your own investment in year one, because we
Right.
leverage debt, and it makes that accelerated depreciation almost equal, if not exceed, the initial equity that was put in the deal. And so a lot of people enjoy that and they try to use it against their other capital gains for a specific year.
Right.
So I have a question for the now in this table, for example, you are showing multiple categories, one at 15 years and one at 7 years and one at 5 years. So is the accelerated depreciation 100% for which category? Is it only for the 5-year category or
The
all
hi-
of them?
no, the highest would be for the 5 years, and the 1.8 also will be accelerated. So you would have higher depreciation, not over 15. They allow you, for example, 40% the first year, and then it will go down. But again, people are looking in the first year to have the high deduction because that's when they contributed the money.
But I mean, the election for the 100% could be done in any category of these 115 or 7 or the 5-year type of investment that you do. It's not exclusive to the 5-year one.
I will have to check, to be honest with you, especially with the changes, because as CPAs, we got all this when one big, beautiful bill, but I did not go through the whole thing because there are just so many changes that happened for the 2025. So I did not cover everything. But one thing I want to, kind of mention here, kind of a note on the side. So the IRS code does not allow you to deduct more than what you have contributed, by the way. So let's say you contributed 250 because as Al mentioned that you are leveraging with debt. So when you do that, then you contribute, let's say $5 million. You don't want to have losses more than the $5 million because your loss will exceed your contribution. So it sounds good, but you are supposed to limit your losses to how much you contributed. So you cannot contribute $100,000 and depreciate $200,000.
Makes sense. Makes sense. Omar, does it not have to do the accelerated depreciation for the other Omar's question? Um, does it have to do with what's land definitely is not part of it?
Right.
Is that true?
Yes, yeah,
Or
you cannot depreciate the land. Yeah.
correct? And then what about my understanding, and correct me if I'm wrong, maybe in the
Mm.
previous laws, that anything that is not the physical structure, so mechanicals, fixtures, doors, windows, etc.
Right.
Is that true?
Yeah.
Usually, there are specific firms that they do the cost segregation. It has some engineering background, it has some physical visit for the property. They need to go through what you have in the apartment complex or in the commercial property to say it is supposed to be categorized this way.
Makes sense. And by the way, what Omar is saying is it's actually two different entities. So we just bought a medical office in Oklahoma City, and we hired an engineering firm to do cost segregation, which is actually splitting these costs into the right categories. What's AC, what's electrical, what's plumbing, what's structure, what's land. And once they do that, then we work with the CPA to translate that. So just to keep it third party and neutral, this is how we work it. We work with the engineering firm first, and then the CPA takes that data and applies the IRS process. So
I thought about doing engineering with the side, but it's too difficult for someone like me to do that.
I think engineering is tough, but no, CPA is way tougher. Just tracking tax laws is a full-time job. I think that one, I think you covered that already.
Yeah, yeah. So basically, it's either you depreciate the things on 27 and a half, 39 years, the whole thing, or you categorize it where you can have higher deduction the first year and then less deductions in the other years. To encourage people to invest more because you invest and then you feel the effect quickly. You don't want to feel it over so many years. You want to feel it the first year.
And it makes perfect sense. One of the things that we do for Investream, we typically target our investment hold period to be 3 to 5 years. So if you get that K1, the paper loss that Omar is talking about within year one, and then you start getting some gains in year two and year three, and then the big gain at the end, then it matters because the entire life cycle of an investment in the way we do business is typically 3 to 5 years. So it really matters. If you do that consistently, you're going to see that at least 1 in 3 years or 1 in 5 years for every investment you do. All right. Switching gears. So we talked about depreciation. And the next question I always get, can I 1031 my property into another property? And I normally don't explain it well, and I say go talk to your CPA because there's bases and other things. But my understanding is yes, you can, but there are some rules. So this is the floor is yours to explain what 1031 is and how you can use it and benefit you
Right.
in deferring taxes, I guess is the right word.
Yeah. So, the idea of the tax planning that we do is we are trying just to defer our liability to taxes. We are not trying to run away from the tax because that can be tax evasion, but we're trying to defer the taxes as long as I can. And this is one of the common ways, which is 1031. Don't ask me where the 1031 came from. I think it's like code number 1031. It doesn't have any meaning for our discussion here. But the idea is look at the original property. We have a property that someone bought for $500,000 and they depreciated completely. So their basis means what is the cost for you is zero. You bought something for 500,000, depreciate every year until it is zero. Now, if you sell this property, then you will be subject to capital gain tax, which is depends, but let's say for the purpose of discussion, 10 to 15%. When you do the 1031, you will say, I don't want to pay taxes. I want to defer this to the future. And the way to do that is I'm not going to take the $500,000. I'm just going to roll that into a new property. So I'm going to buy another property for $700,000. And my 500,000 is coming from the previous property. So my basis in the new one is 200,000. And when you do that, you don't pay any capital gain taxes, and you just roll it into the new property with some detail. So it's not just open for anyone to do it. There's some detail into it, which is on the next one. Okay, here it is. Okay, so there are rules that the government put for this, which is the first one is qualified intermediary. Qualified intermediary means you are not supposed to do this by yourself. You have to go through someone to do it, which is usually the title company or someone that works with the title company. If in our example, you took the 500,000 and then you put the 500,000 on the new property, you lost your chance for the 1031. It has to be deposited, 500,000, to the qualified intermediary who's going to hold the money for you. So you're not going to see it, you're not going to spend it, you're not going to cash it. It's just going to be sitting with someone else. You are not supposed to do this with related parties, means like people are not doing this to help each other. 45 days, you have to identify the new property within 45 days. So when you sell the house, you tell the title company, don't release the money to me, keep it with you. I'm going to do 1031. And then you start looking for another property. Within 45 days, you have to identify this property and to mention that to the title company. And you need to do the closing within 180 days. So you do your study, you do your testing, you obtain a new loan, do whatever you need, but you need to finish the whole thing in 180 days. There are other rules, 95%, 200%, which is if you are buying multiple properties. So in this example, we said the new property is 700,000, but it might be 3 properties that total the 700,000. It is acceptable to do that. But then you have to finish the closing on at least 95% within the specific period of time. The same thing for the 200,000. So there are rules. If someone is planning to do the 1031, you need to talk to someone who's familiar with that. Don't just take the money and say, I'm going to invest the money in something else. That's the common question that we get during the tax preparation, which is, I sold my property and then I took the money, I put it into something else. And that's the issue.
Awesome.
Okay.
Awesome. So 1031, in simple terms, as I understand it, it has to be a property of a higher value. So you can apply that and defer the capital gain taxes for a future exit. And if you keep doing that from a small to a bigger to a bigger and a bigger property and the basis is consistent, then you can continue to defer these capital gains down the road.
Right. They don't want you to slow down. They want you to buy bigger, get bigger loans, and keep expanding. The idea is not to get smaller and concentrate your money. They want you to buy more and get more loans.
Beautiful. Have you worked in the scenario where I have a couple of my investors where they come in and say, can I 1031 into a syndication? And I have not done it myself, but they use a tenant in common process where they can have people on the title but not in the syndication. Have you dealt with someone trying to put the 1031 money into a syndication?
So first, the idea is the taxpayer is doing it in 1031. Means let's say you have an LLC that have 3 partners. 2 of them want the 1031 and one of them they just want to cash out. Then you cannot do 1031. It is the same taxpayer who owns the property one needs to own property 2 without getting people in and out. Make sense?
Yeah, I've heard that people do different things, but I wasn't sure what it is. So maybe I thought maybe they split the LLC and put their name on the title. There were a couple of things that they do outside of the LLC to put their name on the title or a share of the title, but that's maybe I'm not representing the case, right? But we hear a lot about people who wants to say, "Hey, I just sold my property. Can I place my 1031 into a bigger investment syndication?"
I am not sure, and that's what I said earlier. I don't want to claim that I know everything, But there are things that happen one in a million times, so it never happened to me. The typical one is what I mentioned to you, which is, someone owns something and then they roll it to 31. When you have LLC with multiple owners, it's very hard to do because
Got it.
not always, um, you know, they continue with the same goals.
I have few other things. You mentioned that one of the biggest deductions is depreciation. I know typically the other one is mortgage interest. So maybe the philosophy of the IRS of why this is also a deduction and how does it help, obviously, in the net taxes.
Because, people cannot buy big ticket properties cash. You can do that with small items, but when you are getting into apartment complex, shopping centers, medical buildings, we have to have a bank on the side to give us the money, and we have to pay them for the money that they give us. This is the system that we use here. So it's an income for the bank, it's an expense for us. We can deduct that as part of the cost of doing business for all of us, as much as it's a business loan, then you can deduct the interest on the business loan. So, for example, on rental, we have the rental income, and then when we start looking to the expenses, we have the depreciation, we have the interest, we have the property tax, we have the management fee, we have the utilities, we have repairs, capex, as you said. So there are just so many, and that's typically the rental properties are not making money on tax purpose. It's just something that appreciate over time, and then when you sell, you get the money back plus.
A lot of one of the things that I learned earlier in my recent real estate journey is this real estate professional status and how people use it if they're in the real estate space and what advantages does it give them. So can you speak to that on an individual level and on a married couple filing taxes? What benefits does it give them and who qualifies for that?
Sure. So you need to qualify as a real estate professional to be able to deduct your losses from the real estate. So when you have losses that exceed the income with passive and real estate, then you cannot deduct it. You will be carrying that from one year to another until you have big gain and then you will use it. But when you are a real estate professional, you can deduct it every year. You know, usually people are familiar with the 750 hours, right? You're familiar with that. So you need to be working in real estate 750 hours a year. And if you ask anyone, everyone will say, well, I qualify for this because I do more than 750 hours. But there is the second requirement, by the way, which is you need to be working more than 50% of your time in real estate. Now,
Makes sense. And what qualifies is as real estate work?
yeah, that's very, flexible kind of thing. But, if you get audited, then they will ask you, so what do you do for a living? How do you spend your day? What do you do every day? How do you make your income? And then based on these answers, we will be answering 50% or not. So let's say if someone is a full-time engineer in a company, it's going to be hard to say I do 50% of my time in real estate.
Yeah, makes sense. Makes sense. And I've seen a lot of does a real estate agent qualify for real estate work, or this is more in the investing side? Because I get that commonly as a real estate agent versus someone who's actually buying and selling and renting and all that.
So let's say I am a CPA, I have a real estate agent license, and I really sell two properties a year. I don't think I will qualify for the real estate professional status because I do accounting on my day-to-day stuff. Yes, I have a license, but I'm not satisfying the 50% of my time into real estate.
But real estate agency time qualifies had you've done it more than
Yes,
50% of the time.
yes, for sure. Yes.
Because one of the things that I always saw, especially when people accumulate good wealth and they still have high income, is one of the spouses become the real estate professional because they're part-timers as opposed to maybe the big earner, and then they kind of split it that way. I don't know if that's common or not, but I've seen it multiple times, at least in my circles.
Sure. A lot of times, one of them want the other one to be busy, so they just send them to real estate.
All right, so you've touched on the carry and how people can carry their losses forward, and they
Right.
cannot use it the same year if they're not real estate professional, which is the majority of the people. So what does that do? Is there any limitation to it, time-wise? How can they use that carry going forward, and for how long?
No, forward is unlimited. You just go as long as you want. You're fine.
So one of the things so sometimes we have a lot of like busy professionals who are, in oil and gas industry or doctors or what have you, where they cannot really use the losses against their W-2 directly. But we always encourage them that, hey, if you can't use it now, you're gonna carry these losses, and at the end of this investment itself, you're going to have a big capital gain that you can offset within the investment, say, even if they don't have any other K1s.
Correct.
So just want to make sure that we're doing this right. But in general, carrying K1s can go against the future gains, basically.
Right. Now, when you have an LLC and you produce K1s to the investors, they're supposed to be able to deduct that. The question sometimes that happen if you are a limited partner and you have losses, can you claim them or not? But it's something that the management of the LLC can discuss with the different members to decide what best fit them and their tax situation. And if they
Correct.
feel comfortable, if they want to be a general partner or a limited partner, because there is a difference when you are limited versus general. But in real estate, you know, being a general partner, I don't see it as a big liability. But
That is correct. I mean, that we work with both ourselves as general partners and other general partners managing our properties and construction projects together, but we have a lot of limited partners. So my question was more on the limited partner side, who's normally their income is W-2 or 1099 as a full-time job. So it was
sure.
more of a limited partner question.
Mhm. Again, it depends. I mean, to look into the answer, we have to look into specific
Yeah,
situation.
and just typically we tell them go talk to your CPA, but if you cannot claim the losses in whatever
Yeah,
year,
you don't lose it. It will be, carried forward until you sell the property and you have gain, and then you will be able to deduct all the previous losses against the gain of that year. Yes.
perfect. I know this is very dry, and people need to pay attention and focus, but
We're
maybe
gonna test everyone after this
yeah,
presentation.
we're gonna test
Get
it.
ready.
Definitely. Um, so how does someone make sure that they're doing the right thing, they're documenting everything, and they're not just avoiding, paying the minimum taxes, but actually thinking about what they want to do in the future? So how do you work with your clients? Walk some of the audience how you work with your clients, how you plan things with them to make sure that they're doing things right and they're not
So,
reactive.
so really, the slide is summarize what people should do. When you want to reduce your taxes, it's either you wait to April 15, call your CPA and say, these are my forms, how much I owe, and then you start complaining that it's too much and what to do, and I don't have the money and this and this. And then people start coming up with, different ways to reduce their taxes. And usually they are from the first group, running away from the liability. But you're supposed to be planning for it. Don't be surprised that, how much money you're gonna owe. You know how much you're making throughout the year, historically, how much you owe to the IRS. If you owe every year, uh, you need to plan, either to reduce that, either to make estimated payments, or to invest with real estate companies to have some losses. 1031, rental properties, and so on. But if you are waiting for your W-2 to arrive in January and to talk to someone in March or April to see a ways to reduce your taxes, it's too late. The year has already, finished. So you need to do that before. that. So the best way is, get yourself familiar. I always encourage people. It doesn't hurt my feeling when people come to me. It's like, I read this online. Like, okay, we can check together to see if it is applicable or not. It's really good to be an educated taxpayer. We don't know everything. Sometimes people think we know everything. We know some, but we don't know everything. And people are creative in their investments and in their ways to reduce their taxes. And we can validate some of the points that they come. Um, the penalty or imprisonment is not common, I would say, as people might think. But if something is too outstanding, then it will bring attention to your tax return. But it's not something that they do every day.
Yeah, it feels like, the investors of the world, they're like the pharmacists who tell the patient, go consult with your doctor. Tell them about this new medicine. And
Right.
then they go to the CPA and look, you deal with that. Awesome.
I mean, we have, tax becomes a, reality everywhere. Every country have tax one way or another. Governments and countries have expenses, Medicare, schools. So we have to find ways to raise the money, which is the taxes. It's just I want to make sure that I'm paying my fair share of taxes. If I have a way to reduce it that is legal and accepted, why not? If I'm willing to take some risk here and there to reduce my taxes, why not? If I don't want to do any tax planning, then just pay your, taxes and don't complain, I guess. And
Makes sense. Difference between reactive and proactive. This is maybe not related to taxes per se, but because it does use one of the special accounts with the retirement accounts. We always talk to our investors like if you don't invest cash in a property, in a real estate property, then you can invest using an IRA account. And there are
right,
special kinds of IRAs. We typically connect them with third-party custodians who are
right,
familiar with the process, but people can convert their vested 401k into an IRA. They call it self-directed IRA through a custodian, and they can actually invest out of their 401k funds into real estate
right.
without paying taxes or paying penalties, getting that money out of the 401k plan. Do you deal with that, Omar, or is that more on the custodian side? And how do you see this in your firm?
It's usually, they have an IRA account, as you mentioned, and they decide to invest their IRA in real estate. So they need to work with the custodians and their financial advisors. Um, just covering a point that I like always to cover here. If someone is leaving a job, usually they come to you and say, do you want to cash your 401k? And a lot of people say yes. And that's the biggest mistake that anyone can do. So when you leave a job, you move from one job to another. Sometimes, they ask you to leave, separate, whatever happens. Don't take a decision quickly at the time to cash your 401k because that will be a very expensive decision. Take your time to think, talk to someone, financial advisor, before taking the decision to cash out everything. Because people sometimes have the feeling that if I leave my money with them, they might do something with the money. No, they cannot do that. But if you cash, then you are triggering a big ticket tax item in your tax return.
Like how much? Just so give them an
Well,
order of magnitude.
so first they penalize you 10%. If you have a big 401k, 10% can be very expensive. And then you pay on top of that your tax rate. The problem if they separate you in December. So you have a whole year W-2 regular income, and then you take on top of that the 401k. You're going to be paying a lot of taxes. The best thing is not to do anything and talk to someone. The common thing would be, for example, even if you need the money, to take it in January, for example. Don't take it in December, because if you take it in December, then you're going to be screwed. Or you move it to an IRA and you withdraw as you need. Sometimes we think I need the whole thing, or, bad scenarios. Yes, as, Sammy said, roll over. That's the best thing. So you roll it over to somewhere else. But don't feel pressured to cash it. If you cash it, it's too late a lot of times. You cannot bring the money back with circumstances.
Love it. Love it. Thank you, Omar. That was great. Let's see if we have any questions in the chat.
One general question. I wanted to know what is really have changed. I know the 100% really was the new thing in the new bill. The other things about 1031 or other investment through IRA, did this remain the same or anything changed on that one, that part?
To my knowledge, it is the same.
Same. Okay, just
Yeah.
the 100% depreciation, that was the big change.
Yeah. So there is, more about the 100% depreciation, the standard deduction. They allow you now to have the car loan interest deduction. Some changes in regards to the tips for those who are working in the, restaurants, industries, and they can, save some money on that. Things like the charitable contribution, the 529, things like this, but nothing in specific for the investment. So depreciation is the biggest thing.
Great. We have a question for Vanessa from Vanessa. What is a valuable resource to use to get the latest correct tax updates so we don't have to ask CPAs?
Sure. I mean, of course, you can Google stuff. So as I said, like the one big beautiful bill, it's so big. It's not what people think that, we know all the details. There are more details, and usually after they finish the act for us as CPAs and tax preparers, that act will go to the IRS. They need to come up with forms and adjustments to the forms and to the softwares. So we don't get everything now. It's gonna take months before this can be reflected on forms and softwares. But you can Google stuff, you can watch some, videos here and there, listen to people. There are people who are specialized, for example, with tips. So if that's applicable to you, you wanna maybe listen to some of the videos that is related to that.
You didn't mention ChatGPT, so I'm assuming Google is better.
Or Google, yeah, same thing.
Awesome. All right.
Good.
It sounds like Omar, you did an amazing job. Thank you for explaining difficult things to our simple investment minds. We really appreciate you joining us tonight and spending the night with us, and have safe travels tomorrow to wherever you're going. And for everyone else, we appreciate your presence today, your questions and feedback. And we will see you in the next webinar in October. Thank you, everyone, and have a great night.
Thank you.